Welcome students, welcome to lecture number 4 where we will be covering module number 1 under subject financial management. So as we know that this particular module, that is introduction to financial management, covers the aspects which we have already covered in lecture number 1, 2 and 3, and today we will be dealing with the remaining part, that is what is a risk management, behavioral finance, financial engineering and derivatives. So basically risk management, behavioral finance and financial engineering are some issues relating to the financial management. So let's first understand the risk management. So what is risk management? So in short, risk management is nothing but managing the risk. Now which risk? Managing financial risk, because we are seeing the issues in financial management. So one of the issues in financial management is to manage the financial risk. Now let us understand what is financial risk. Financial risk, as you know, is a risk that includes maybe currency risk. Many a times the value of a financial instrument, which is a currency, it may fluctuate due to the foreign exchange rates. So there's a financial risk attached to a financial instrument that is a currency. So the value of the currency keeps on fluctuating based on the foreign exchange rates. So there is a currency risk attached in respect of financial risk, and help of management, it will help us in managing that particular currency risk, either by entering into forwards, futures or swaps, which we will be seeing at. So basically risk management is nothing but the identification. First you're going to identify which all are the risk that can be attached to the financial instruments, then analyze what would be the impact, okay, how severe the impact would be, assess the degree of their effect, control. Apart, once you know what is the financial risk, you will take means and measures to control that particular risk, and avoidance, either you avoid the risk completely or you minimize it, or elimination of unexpected risk. So risk management basically starts from identifying the risk to analyzing it, assessing it, controlling it, and after knowing whether it can be controlled, whether that risk can be completely avoided, eliminated, okay, depending on that you're going to manage the financial risk. So an organization may use risk assumption, risk avoidance, risk retention, risk transfer, or any other strategy, okay, in proper management of future events. So the different strategies available in respect of any company or business unit is either it can assume the risk, either it can avoid the risk by not entering into such financial trading financial instruments, either it can retain the risk. If the risk level is too very low, it can retain the risk, that is it can keep the risk without giving a control on it, or whether or either it transfer the risk by transferring it to any insurance company, transferring by the way of derivatives or any other strategy. So basically now let us understand what are the different financial risks. As I've already told you all, the first financial risk that we come across is a currency risk. Then currency risk, as you'll know, that there are various currency transactions happening. These currency the value can differ, the risk is attached in respect of the fluctuation happening in the foreign exchange rates. Okay, so basically during the transaction cycle which is associated with the exports or import of goods and services. So basically this financial risk in respect of currency will appear when you all are into exports or imports of goods and services. This risk is always been attached, and this risk is nothing but a financial risk. So what the party, like whoever is the exporter or the importer, what they can do is either they can avoid the risk, okay, they can eliminate the risk, or either they can minimize the risk depending upon the fluctuation. So usually the importer or exporter, they will assume or they will predict what will be the foreign exchange fluctuations happening, and then they will enter into derivatives, and derivatives will give them a little way in which they can eliminate or reduce their risk. So regarding derivatives, we'll be seeing in our succeeding slides in detail. Next risk can be interest rate risk. So what happens in interest rate risk is the interest rates keeps on fluctuating. Okay, and when there is an interest rate changes that is happening, it will always affect the financial well-being of the entity, because you see that the bond prices keeps on changing, interest rate fluctuations are happening so much that they will directly affect the economic growth, they will directly affect the stock prices, okay, and adversely affect the liquidity of the cash flow that is happening. So we have interest rate risk, we have liquidity risk. Now what is the meaning of liquidity risk is there is a cash flow risk. So what happens here is, here after realizing the assets, that is after selling the assets, there has to be sufficient cash, okay, or sufficient amount of cash to raise the funds, okay, that is associated with the financial instrument. So what does this mean? That every entity will encounter some difficulty in realizing their assets, okay, because what happens, you realize the assets, immediate cash you may or may not get. So there is a liquidity issue, that is the how long will it take for an asset to convert itself into cash. So there is a liquidity issue happening, and that is basically related to the cash flow risk. Next you have is a credit risk. Now what is credit risk? That is, suppose you entered into a contract with some person, and that person fails, and you have entered into a contract on credit, and that person fails to perform his duties in the contract. Here what happens is, since he is liable to pay to you some amount, and if there is a failure in payment of such amount, then there is a credit risk attached. So what happens here is, the possibility of the risk may occur when the failure of another person, another party, he fails to perform his obligations under a contract. Okay, so what happens if he is unable to pay the debt to you, if he is unable to pay the amount back to you, there is always a credit risk that is being attached. So suppose that there is a larger amount debt that is payable by that creditor to you, then what will happen? There is a larger amount of credit risk. So these are all the financial risk that are being attached, and risk management is a means. So whatever financial risk, what I have told you, they are the emerging issues in the financial management, and with the help of risk management, the risk can be, each risk can be identified, analyzed, minimized, avoided, okay, and either it can be accepted depending upon the materiality, that is depending upon the amount. If the amount is too very negligible, it can be retained. If it is very material, then it can be either transferred, or either it can be, means or measures can be taken to minimize the risk. Next, there is something, a concept called as behavioral finance. Now what is behavioral finance? It is a study of the influence of psychology on the behavior of investors or financial practitioners, and ultimately the subsequent effect on the markets. So many a times there are people who predict that the share price will go up or will come down. So how do they study this? So they study this with the help of behavioral finance. So behavioral finance is nothing but where the psychology of the investors are being predicted. Like a particular set of investors, they will walk in a particular way depending upon the market conditions. So studying the behavior of the investors is behavioral finance. And how will it help? Because once if they have studied their nature properly, they will know whether the price of a particular share will go up or go down depending upon the behavior of the investors. So behavioral finance also can easily help to know what will be the effect on the financial instruments that are operating in the financial markets. And it focuses on the fact that investors are not always rational. They have limits to their self-control and are influenced by their own biases, which means that, now suppose if I am an investor, okay, I may not always use my mind invest any particular category of financial instruments. So what I will do, suppose if my friend or my other company in which I may be a director, if suppose that company friend is saying no, the shares of this XYZ company is better, why don't you put there? So many times what I how I react is I may get biased by others' decisions, and I may get carried away by others' decisions and thoughts in respect of investments. So many a times it is possible that the investor will not use his own brain, but he get carried away by other person's decisions or other person's investment. Suppose if XYZ is investing, why should I not invest in that particular share? So usually many a times this is what happens. Behavioral finance also fails because many a times it is very difficult to understand the behavior of an individual, because the individual may not act in his own way. He may act in the way that others are acting in respect of investment in financial instruments, or um, or in respect of the share that traded in the market. Now next, financial engineering. Now what is the meaning of financial engineering? In financial engineering, what happens is it is use of mathematical techniques to solve all the financial problems. Financial engineering uses tools and knowledge from the fields of computer science, statistics, economics, and the applied mathematics to address current financial issues as well as to devise new and innovative financial products. So basically, students, financial engineering is nothing but it is a particular technique in which what happens is many financial engineers, what do if they want to solve some problem or financial problem, or if they want to bring in a new financial product in the market, what do? They use all the different types of tools that are available, not only with the help of with which they learn finance, but they take the knowledge from different fields like computer science, statistics, economics, and with the help of all these different particular resources, it comes to a solution. So I can just give you an example for demonetization. Now, during when Modi realized that there is lots of black money circulating in the market, so with the help of financial engineering, they found out the ways or solution through which this particular financial issue, what was happening in the market, could be curbed or could be reduced. So he came up with demonetization, where the notes, old notes were, restricted to be used ahead, and he brought in new currency notes. So this is just an example. And apart from that, they also may bring a new financial product in the market, where which will help in the economic growth of the country. So basically, financial engineers, what do? They run the risk models. They keep on, inventing new things and just trying out the models in order to know how the investment tool will perform, whether a new offering is happening in the financial market or no. That means they get a new product and they will see how that new financial product is responding to the investments that is happening. And yes, if the investments happening are at a higher range or at a higher level, then they will be taken ahead. Otherwise, financial product will there itself come to an end. So financial engineering is basically for the solutions to for finding the solution to the financial problems, or bringing out a new financial product, not only with the help of the study of finance, but also with the help of different methods. So this is all about financial engineering. So we saw what is risk management, we saw what is behavioral finance, we saw what is financial engineering. Now let us understand what derivatives. So basically, students, a derivatives is a financial contract. When I say financial contract, means contract. Contract is between two persons where there is a obligation to fulfill that contract. It is a legal contract. When I say financial, means it is always in monetary terms, or there is a monetary value attached to it. Okay, so this is a financial contract that derives its value from an underlying asset. So the value of this contract is being derived from the underlying asset. value is to be predicted. Okay, it is not a, it's a value that will be predicted and will derive itself from an underlying asset on which the derivative is being attached. The buyer agrees to purchase the asset on a specific date at a specific price. So here in derivatives, what happens is when the buyer is thinking that the price of the asset may increase in the future, he's predicting, he's not sure, he's predicting that the price of the asset may increase in the future. So what he will do, he will enter into a derivative with the seller, okay, that I purchase this asset on this specific date at a specific price that is agreed between the buyer and the seller. Suppose on the future date, if the price of the asset, so just give you an example, if the price of the asset is suppose 1 lakh rupees, okay, and the buyer has entered into a derivatives for purchasing the asset as at 1 lakh rupees, and later at future date the value of the asset has become 1,50,000 rupees, but still the seller has to sell the buyer the asset at 1 lakh only and not 1,50,000 because the buyer had entered into a derivative with the seller. So here the underlying assets value will be 1 lakh rupees and not 1,50,000 because the derivative contract was being entered for a value of 1 lakh. So it is the buyer agrees to purchase the asset on a specific date, the date whatever date is mentioned in the derivative contract, at a specific price, irrespective of the price prevailing in the market at that particular point of time. So once the price is fixed in the contract, at that price only the sale will happen. So sometimes the buyer may also sometimes the buyer may also get into losses. Suppose he has fixed the value to purchase the asset as 1 lakh and later the value of the asset comes down to 90,000. So now there is a loss to the buyer and the profit to the seller. Derivatives are traded between two companies or traders that know each other personally are called over the counter options, and they are also traded through an intermediary, usually a larger company. So usually derivatives are traded over the counter, as well as you can enter into derivatives with the help of banks as well. So I hope you have understood what is derivative. It is nothing but a contract in which you will enter into a contract to purchase any particular asset or financial instrument at a date, at a specified price, irrespective of what is going to be the exact price. This is just to make sure here the buyer will enter into derivative assuming that the price will go up, and the seller will enter into a derivative assuming the price will come down. So what the price will keep on fluctuating. So this is a financial risk, but derivative is a type of a solution which will help to secure that particular risk. Next, the types of derivatives, like we have seen forwards and futures, option and swaps. Now let us see what is forwards and futures. Like I have already explained that forwards are nothing but it is a contract, forward contract. It is a customized contract. When I say customized contract means the buyer and seller will negotiate on their own terms and conditions. So forward, when you enter into there are types of derivative students. So when I enter into a forward contract, I will customize. It is a customized contract between two parties. There are going to be two parties. One is going to be the buyer and one is going to be the seller. And why do they enter into a contract? To buy or sell any underlying asset. See, when I say underlying asset, I don't know what is the name of the asset. There can be any asset for which they will be entering into a contract, that is derivative contract, on a time at an agreed price today. So forward contract, just remember students, forward contract is a contract that is entered between two parties, the buyer and seller. It is a customized contract and it is a contract to buy or sell any underlying asset, okay, at a price which is agreed today. We don't know, they may enter into a forward contract for a period of 3 months. We don't know the value of the asset after 3 months. If it is increases, it is benefit for the buyer. If it decreases, it is a loss to the seller. So here what will exactly happen in the forward contract is buyer will be betting or predicting that that the price will go up, and seller will be predicting or will be betting that the price will go down. So when they're entering into the contract, they have these thoughts in their mind. Okay, and when they enter into a contract, no money is exchanged. They will not exchange any money until the settlement date. Now, when is going to be the settlement date? That is the specific date. Now, I said specific date. They will decide a date on which they will be settling the contract on a price that is agreed today, and not at a price that will be after the on the specified date. So this is all about forward contracts. Next is future contracts. Now, future contract is again a contract between the buyer and seller, okay, which has an expiry date. That is up to a certain period of time. Future contracts, the buyer and seller will enter into, and again they have two participants. Okay, that is the buyer and the seller. And the in future contracts, what happens exactly is it is a standardized contract. First of all, it is standardized. Here I say forward contracts are customized, but future contracts are standardized because they are traded on an exchange, and the prices are settled on daily basis until the end of the contract. So every day they will be checking the prices until the expiration date. Okay, the prices will be settled on daily basis. So these are future contracts. Next is you have is options. Now, what are options? Options are nothing but again it is a particular financial instrument. It is like a sorry. Options are nothing but again they are derivatives, and these derivatives gives an option to the seller as well as to the buyer in order to buy or sell any particular underlying asset at a predetermined price. So what happens is these options give the buyer the right but not an obligation to purchase or sell the underlying asset at a predetermined price. So when I say right but not obligation means in forward contract what happens is irrespective of whatever the price is, the contract has to be executed. But in case of options, the buyer is given a right but not obligation. That means the buyer is only having after the expiration period or at the specified date, the buyer, if he wants, he can execute the contract, or if he wants, he cannot execute the contract. There is a right, but there is no obligation. So there is call option. There are two types of options. Again, under options, there is a call option and put option. So depending upon the option type, the buyer can exercise the option on the maturity date. Okay. So if he executes the contract on maturity date, it is called as an European option. And if he executes the contract before the maturity, it is called as American options. So options again are nothing but they are derivatives, form of derivatives, where there is a right given but not an obligation to purchase the asset at a predetermined price. And options can be executed or can be exercised before the expiration date or after the maturity or on the maturity date, not after, on the maturity date. Now next, what are swaps? Now derivative contracts also allow the exchange of cash flow between two parties. Now, the swaps usually involve the exchange of cash flows for a floating cash flow, a fixed cash flow for a floating cash flow. Now, the most popular type of swaps that we come across is interest rate swaps, because interest rates keeps on fluctuating. We have commodity swaps and currency swaps. Now, what happens in swaps is here there is an exchange. Swap means exchange of fixed cash flow for a floating cash flow. So here what happens basically is those financial instruments which keep on fluctuating and which are not fixed. Swaps contracts are usually entered for such particular type of financial instruments like interest rate swaps, commodity swaps, currency swaps. So swap is again a type of derivative. So students, is this clear? So basically, just you need to have in detail, you do not have in this chapter in detail in respect of option swaps, but you just need to know what is the meaning of forwards, futures, option swaps. So did you all understand what is the meaning of derivative? These are the types of derivatives. Yes, students?
Ma'am, yes, ma'am.
Okay.
Ma'am,
Yeah.
ma'am, can you repeat meaning of swap?
What I